Good evening, ladies and gentlemen. Thanks for joining us tonight for REITs Outlook, the future of REITs. Firstly, I would like to welcome Mr. Richard Dyson, General Manager, Planning, Education and Research, CIAF, to give us an opening address. Richard, please.
Good evening, everyone. Welcome to this REITs Market Outlook. What the future will bring. We're taking a crystal ball here. The COVID-19 pandemic really has accelerated change in real estate, ushering a new era in the industry. Still, a stark reality beckons. Surviving the pandemic is one thing, navigating its aftermath with demand and structural trends evolving will be a more involved process. As lessons from past crises show, timely and bold moves are necessary to recast the future for growth in the new normal. Throughout 2020, government efforts across the Asia-Pacific to contain the spread of COVID-19 has propped up the real estate markets. However, these measures are transient. When the tide of support recedes, the fundamentals will show. There is a sense that real estate requires a reset to redefine their place in the city and the economy. Only time will tell. There is growing awareness of health and environmental consequences, as well as a shift towards agile workspaces. Issues that the industry can no longer put off. Better buildings will no doubt form the core of the post-pandemic city. Asset owners and landlords will need to be proactive with measures to entice shoppers and office workers back into their multi-million-dollar investments. And in Singapore's case, it's multi-billion-dollar investments. I am sure we will hear more from this later. REITs can be at the forefront of the industry's transformation. Let me explain why. That distributes the majority of the profits back to investors, REITs with an onus to continually undertake yield-accretive investments through acquisitions or repositioning assets to sustain dividend payouts, are incentivized to catalyze these changes. From flexible spaces, integration of technology, and wellness features, REITs are well equipped with asset management expertise to spur a reoccupation of commercial real estate. With the cost of capital remaining conducive, the region's REITs are angling for a recovery, taking advantage of any pricing dislocations to expand their portfolio and bulking up through M&As to compete in an era of opportunities. In Australia, for instance, REITs are eyeing Blackstone's $3.5 billion logistics property portfolio divestments. M&As is just one part of the story. Developed markets REITs are scaling up in order to bolster firepower and compete for assets. So with this context in mind, let me hand over to Mr. Jeff Howie, market strategist at SGX, to give us an overview of the performance of the Singapore REIT sectors. Welcome, Jeff.
I'm Jeff Howie. I'm the SGX market strategist and intend to provide a very quick overview of our REIT market for the next 15 minutes, really focusing on the highlights. I should point out that this is predominantly a purely informative session, at least this part is, with recent observations on the stock market, and it is no way providing investment advice. Okay, so we're very fast approaching 20 years since 2002. When Singapore established itself as a REIT market, and it has now grown to be one of Asia's largest REIT and property trust markets. It has more than 40 property trusts that consist mostly of real estate investment trusts, in addition to 5 staple trusts and 2 business trusts. Now, by the end of April this year, the combined market value of the S-REIT sector stood at 111 billion Singapore dollars, and that represents around 12% of the combined value of all stocks that are listed for trading on Singapore Exchange. The combined market value of the S-REIT sector has grown significantly over the past 10 years. It's grown at an 11% compound annual growth rate over the past 10 years. And this is not really just down to performance. Portfolio growth through acquisitions, and funding those acquisitions through methods such as secondary fundraisings that include placements and rights issues has been a part of this. Recent examples include Ascendus REIT completing its acquisition of the 11 data centers in Europe, and then you've got Ascendus India Trust as well, entering into a forward purchase agreement to acquire 2 buildings in an IT park in India. Now, in the year to date, the S-REIT sector, it has averaged day-to-day turnover of $250 million a day. So that represents around 17% of the combined day-to-day turnover of all the stocks that are listed on our exchange. The 3 SGX listed ETFs that do offer investors some diversification into Singapore and regional REIT markets, they have posted year-to-date net inflows of $93 million, and that brings their combined AUM to $560 million. The Nikko AM Straits Trading Asia ex-Japan REIT ETF and the Lion Phillip S-REIT ETF are also among our top 5 most traded Singapore-listed ETFs in the first 4 months of this year. And I should also mention that of our 30 ETFs that are listed on SGX, the Nikko AM Straits Trading Asia ex-Japan REIT ETF and that Lion Phillip S-REIT ETF rank among the top 3 yielding ETFs with their yields at 4.1%. So it's enough for ETFs. For the REIT sector, as we say, it is recognised. It's been recognised as a regional REIT hub for some time, and more of late as a global REIT hub. As many of our 16 of the trusts are basically exclusively investing in property assets outside of Singapore, with 19 of the trusts investing in properties in both Singapore and outside Singapore, and the remaining 5 REITs investing purely in Singapore. And this includes as many as 10 REITs with properties in China, 7 REITs with properties in Japan, 6 REITs with properties in Malaysia. And the REITs and the trusts, they are also very highly diversified across property types, with a balance across retail, industrial, office and hospitality properties, in addition to multiple REITs that are investing in healthcare related properties and specialized REITs such as data centers. Now, last year's strongest performing REIT was actually a data center REIT. It was Keppel DC REIT. Now, with 48% of its rental income coming from the internet enterprises sector, Keppel DC REIT was the 5th strongest performing REIT across the APAC exchanges last year, and was in fact the 11th best performing REIT across the world for the year in 2020. And I think we're all pretty much looking forward to hearing more from Anthea in the upcoming panel session on this trust, which was actually the first Asia pure play data center to list on our exchange back in December 2014. And so far this year, it's been ARA Logos Logistics REIT, which has been the strongest performing S-REIT in Singapore, and the 4th strongest performing REIT across the APAC exchanges, and among the top 40 performing global REITs. It's, I should qualify that, among the top 40 performing global REITs with a market value of at least $500 million US. Now, for the March quarter, the business update for ARA Logos Logistics REIT reported 36% year-on-year DPU growth and an overall portfolio occupancy committed occupancy rate of 99.1%, and it also noted completion of the acquisition of 4 logistic properties in my hometown of Brisbane, and also noted it completed the interest in 2 fund investments, and it of course continued its asset enhancement initiatives, which are obviously a key theme among the REITs at the moment. So there's just a few highlights. I should also point out that on the valuation front, valuations are currently highly competitive here in Singapore. Our S-REITs average a 1.04 or a 4% premium to book value, a 1.04 PB ratio, which is very close to the 1.03 or the 3% premium to book value, which is the median for the more than 250 REITs listed across the Asia Pacific. Now, despite Singapore REITs maintaining a global ratio, a gearing ratio limit of 50%, their current average gearing ratio is 37.8%, which is also below the global median debt to asset ratio at the moment, which is 39.2%. The average yield of the REIT sector is at 5.6%. That's above the global median yield of 4.1%. And for the S-REITs, office REITs currently maintain the highest yields, averaging 7.1%. And then you've got industrial REITs following suit with 6% yields, and then hospitality REITs currently averaging yields at 3.2% at the other end of the spectrum. With the Singapore 10-year bonds, though, currently near 1.5%, and the full, I guess the full 2021 year estimates for the FTSE ST REIT index to yield 5.2%. The REITs are based on that index. The REITs are maintaining a 370 basis yield spread or basis premium to the actual benchmark 10 years. And I guess aside for a penchant for real estate investment, yield has continued to be a key aspect of the S-REIT market, and that has attracted retail investors. So far in the 2021 year to date, retail investors have been net buyers of the S-REIT sector, while institutional investors have been the net sellers. We also observed across the entire 2020 year that as well, with the retail investors being the net buyers. So the S-REIT sector has seen net retail inflows of $520 million so far this year, which followed $1.2 billion of net retail inflows in 2020. Moving just to just one more quick slide, I just wanted to show how in Singapore our S-REITs have averaged 7% gains in the 2021 year through to the Friday close, and that brings a 12-month average gain to 18%. And this is very similar to the APAC median, which is also 18%. Or 17% thereabouts for those 250 APAC listed REITs. The global REIT sector, which is fast approaching a combined market value of $3 trillion, has generated a 9% median gain in the 2021 year to date. And a key driver of global REITs in both last year and the 2021 year to date so far has been obviously the type of properties that make up the REIT portfolio. So across the globe, you've got social and economic lockdowns, social distancing, and safe place work practices weighing the global hospitality REITs, the global retail REITs and the global office REITs in 2020 across the board, across the world, with median declines for the global REITs at 30% for the, as you can see in the red bar on the chart, for the hotel REITs, 14% for the office REITs, 19% for the retail REITs last year. Now, meanwhile, the demand for technology-driven solutions last year saw the data centers across the world outpace. They were basically the only REIT sector, major REIT sector in the green for last year. With the imminent vaccine rollouts that were announced in early November last year, we've so far seen 1.3 billion vaccine doses administered, which has translated to around 320 million people across the world now fully vaccinated. And this development, as well as, I guess, the inherent, albeit still, I guess, uneven economic rebound, has seen the 2020 laggards, hospitality REITs, retail REITs, and office REITs, lead the global REIT market in the 2021 year to date, while last year's data center outperformers have so far ranked as the 2021 laggard. But at the same time, the world is no means near the finish line. Virus resurgences, variant strains are still impacting, obviously, our lockdowns, our ability to facilitate international tourism and travel. And this means that, I guess, the REIT subsector moves in the year to date have been somewhat measured or tentative. When you see global hospitality REITs, they did generate a median decline of 30% last year, but the recovery so far this year has only been partial. It's been a 13% gain. Likewise, the 17% return of data centers in 2020, it hasn't really been erased. It's rather just been trimmed with a median 1% decline so far this year. Hence, investors, they may have rotated among the REIT subsectors, but the subsector performances have certainly not seen full turnarounds. And I should also point out that globally, industrial REITs have posted median gains. Global REITs have posted median gains both in 2020 and the 2021 year to date, with warehouse, business parks, and logistic efficiencies, I guess, supported by the growth of e-commerce, technology, and the consumer good industries, not to mention the resilient trade growth we've seen across the world. So industrial REITs, they do play important roles in the international manufacturing supply chains, and manufacturing has been, as we know in Singapore, quite comparatively resilient over the past 12 months, supported by the rising Asian middle class, the consumer economy, urbanization, advances in technology, and of course, e-commerce deepening the regional supply chains. But with these key sub-trends setting the stage, I guess, for unit performances over the past 12 months, the second table here that I've got just reflects a balance, I should mention, in terms of the type of properties that make up the 9 S-REIT portfolios that have seen double-digit gains for the past 12 months and still maintain yields above 7%. So I've just listed those 9 REITs there for you to take a look at, and I think we featured that in the last night SGX My Gateway report, which I'm sure most of the viewers tonight are already receiving. I should just mention too, just one final point on the indices. As an index, S-REIT indices have provided exposure to the region's highest dividend yields, as well as the lowest annualized volatility in past years. And from an index perspective as well, this sector really does punch well above its weight in terms of global indices. Singapore contributes almost 3% to the weighting of the FTSE EPRA Nareit Global Index, which is around 8 times as much as its weight in the FTSE World Index, which is made up of just the whole global stock market. I should also just quickly wrap it up. Should also mention we've got our Telegram channel, colloquially called SGX Invest, and encourage you to find us on Telegram, as it does provide a means for us to provide some daily updates. And advertise the CS events on there as well, and emails. Our SGX My Gateway report is still in service, and you're more than welcome to resubscribe if we've lost you in recent years. Okay, so I'll stop sharing now, Rich, and yeah, exactly 7:20. Great, hand it over to you.
Thanks, Jeff, for that quick overview. And a lot of people don't realize that, Singapore, well, the S-REIT is actually the largest REIT market in the Asia Pacific. And when we first started, I recall, and I was at SGX at that time, every REIT will be trading below NAV, and that was the early days. Today, I think we see things very differently. I mean, there are obviously a few that are still below NAV, but as the average is just slightly above.
Yeah. Well, 2006 was our big watershed year where we really expanded the market capitalization, had a very strong, I guess, performances going into 2006. And I think that it did take a few years, Richard. I remember, I wasn't here at the time, but I have obviously read up.
I was there.
You were there.
We were busy plugging it around, and it takes, as you say, everyone to be able to do this collectively, from analysts, issuers, and also the SGX. And with that, let me could you stay online and let me bring in our other panelists this evening. We have with us today a panel of experts, a slew of experts who have worked tirelessly during this pandemic to ensure stakeholders are looked after. So could you please welcome the panel today, Ms. Anthea Lee, CEO of Keppel DC REIT, Mr. Simon Kering, CEO and Executive Director of Cromwell European REIT, and Mr. Tony Tan, CEO of CapitaLand Integrated Commercial Trust. Welcome.
Thanks, Richard.
I'm going to just kick off a couple of questions. I will be taking questions from the panel, from the members of the public in a bit. So, ladies and gentlemen, I'll kick off some of the questions in the Q&A. But if you'd like to ask questions of our panel, please use the Q&A function below, and I will be going off to them and actually addressing them in a few minutes. With the context of recovering global economy, a spike in the COVID-19 cases in some countries, especially in India, as well as Singapore's own move to phase 2. Jeff, I'm going to first ask you, how do you see the STI and the property market in particular perform over the next few months?
Well, the STI is very much moving in line with what most global benchmarks are doing, and they have been staunchly sector driven. But much of that, in terms of the key driver, is of course the social and economic recovery focus that is around COVID-19. Okay, so just from a broad perspective, there's been a much more focus this month on the pace of the vaccine deployment. Okay, since the end of March, new global vaccine doses have averaged across the world around 18 million doses a day. However, if we did keep that comparatively very steeper momentum of the first quarter and kept that momentum going, we'd be currently distributing around 23 to 24 million doses a day. So the Biden administration obviously is very supportive of COVID vaccine patent waivers, but it's not going to happen overnight, as it requires WTO buy-in, which is very different to getting WHO buy-in. But with the spread of the double mutant strain, as you noted, India is now accounting for as many as 15% of the total 159 million cases of COVID-19, and that's well up from 9% at the end of March. Okay, so that still remains the underlying driver. Okay, that's as the Fed Reserve Chair noted a couple of weeks ago. One good job report back for March, and it followed up with a not so good one in April. But even that one good one in March did not constitute substantial progress, and there was a long way till the finish line. So the monetary support is still there, expected to continue. We can talk a little bit about inflation and the key number that comes out tomorrow night and the ramifications for that. But for the moment, just to keep it in terms of the key drivers, for the Singapore property market, it really, as we said, depends on the property type. For industrial REITs, much depends on the level of excess supply in the market and whether closures really exacerbate in the coming months or the coming quarters. Well, I guess the trade-related growth will also be a key determinant, which itself is growing significantly. And I guess there's also the asset enhancement initiatives, a key sub theme for the industrial subsector. For the office REITs, much will depend, I guess, on the delays from the slowed construction, or how much the delays in the slowed construction and I guess increased demand from ICT tenants are able to offset the more adverse impact of potentially further downsizing by office tenants, and I guess less than expected growth in the service sector, which we are all expecting more growth this year. And for the retail REITs, I guess excess supply is not so much a concern, rather the ongoing concerns of less tourists. So nevertheless, you've got Mapletree Commercial Trust noted when they increased their DPU, I think, for the second half of their financial year, up 58% year on year. They noted that the tenant sales last quarter had recovered to more than 86% of pre-COVID levels, in tandem with the phased easing of COVID-19 protocols. So, you know, looking beyond that in terms of key themes, you know, it all depends, as we said, the property type. Manulife provided a business update this morning, and they noted that post-COVID, key themes would be acceleration of population, company migration in the office sector REIT, the growing tech sector, strong demand for healthcare, and the fast and developing knowledge economy. So a number of these aspects that apply versus to exact which property type and so forth.
The short term, we'll be looking at a new metric called penetration of people who have been vaccinated. That is one of the key metrics we're looking at these days.
Yeah, it is. I mean, we like, you know, I guess last month, we saw in the beginning of last month, the IMF chair said, you know, we can see the finish line, and then President Biden said within a day, no, we you know, we've still got a long way to go till we reach the finish line. I mean, we've only had 1.3 billion vaccine doses administered, Richard. That there's still a long way to go, and the good news is that momentum that we were seeing in the first quarter had waned somewhat. That's the bad news, but the good news is that action is being taken to get that globally, to get that momentum going again, so that we maximize every day with vaccine doses.
Bring Anthea in. Anthea, just do you expect any material change in the business environment, risk factors, or financial performance for a capital DC REIT, just given the context of these, you know, current respike in the spikes in COVID-19 cases, these additional variants?
Right. Hi. So good evening, everyone. So our assets have been classified as essential service globally and have been able to operate without any disruptions, even during the whole of last year and continuing this year. So whilst the lockdowns or in Singapore context circuit breaker, it tested our business continuity plans, we have been able to manage without any impact arising from the pandemic. And occupancy-wise, we have been able to get our portfolio occupancy to the highest level in our entire history of operations at 97.8%. And with that, we do see actually positive impact in terms of financial performance of our REIT.
I'm going to bring in Simon as well. Simon, this question also relates to, this is also the same question to you. Do you expect any material change in the business environment, risk factors, or financial performance for Comwell?
Yeah, thanks, Richard. And again, thanks to SIAS for hosting us all tonight, and welcome to your stakeholders. So just very briefly, to set the scene, Cromwell European REIT, as per label, invests across and logistic assets. And we've recently announced a pivot further towards logistics. Not just because of the structural changes that Jeff was talking about in terms of e-commerce, but also post-Brexit and with the world's response to some of the trade frictions over the last few years. There's a lot more in-house within Europe. A lot more widgets are being made within the supply chain in Europe, as well as new markets opening up from Asia into Europe via countries such as the Czech Republic and Slovakia and Poland, which are gateway freight hubs. So that's something that we're very much looking forward to over the next few years as that trend continues to play out. To go to the e-commerce a bit, for those you know, who've travelled around Europe, it's almost a distant memory now. You know, the traditional shopping methods of a lot of the Europeans, particularly in the Mediterranean countries like Italy, online sales has been very small. And in fact, up until 2019, some of these countries, such as Italy, have had only 3% of their total retail sales through e-commerce, through online. What COVID has done is massively accelerated the take-up of not just internet broadly in some of these markets, but also the experience. And so we've actually seen a doubling of e-commerce in the last 12 months. And that's put a lot of stress on the logistics, on the warehouse, on the supply side, such that we've actually, even in a recession such as the world's been going through, we've actually been seeing vacancies reduce in the logistics markets throughout Europe as the standard 3PLs, the DHSs, DHLs, the UPSs have been taking up more space. And we can see that in our results today, where we've announced underlying positive rent reversion of 3.5% from our logistics fund. We can talk more about the structural issues within office, but I think at this very point, most of our office tenants we're working closely with on the ground to actually get their staff safely back in as Europe comes through its winter lockdowns. And we're just starting to see cities open up. We're just starting to see the lockdowns retrace. To Jeff's point, Germany now, after a very slow start publicly, we've seen that here in Singapore, Europe having problems in the first quarter. Germany's now only 7 or 8 weeks behind the US in terms of its vaccination program, in terms of its population now. So almost 40% of Germans have received at least one jab, and the rest of Europe is not that far behind as they've been really focusing on the last few weeks. So that is something that we're holding on to from a recovery in the economy. That will leave behind still this structural element that I'm sure we'll talk about in later on tonight. But that's barbell for us. Move into logistics where we see a lot more growth, underpinned in our office portfolio by very long-term leases to government, etc.
Thanks, Simon. I'm just going to bring Tony. Tony, now with basically with the integration, now with CICT. Do you expect any material change in the business environment, risk factors, or financial performance for CICT?
Am I still muted?
We can hear you now.
Yeah,
thanks.
sorry. Yeah.
Yes.
So, well, I think most of the risk factors are known. In fact, if you recall, I think I'm sure the audience here could relate. I think we were really at the forefront of basically we're at the front line of the entire battle against the COVID-19, with our guys on the ground. So all those risk factors are pretty much known. What, of course, now we are living through is that we probably got to get used to, at least in the short to medium term, a little bit of ebbs and flow, like what we're seeing now, some resurgence in the infection rate around the world. I think so long as, like Jeff nicely put it, so long as the world does not, do not get fully vaccinated, we probably get episode of such spikes on and off as we move along with our business. So I think we probably got to get used to it. I think for the entire year, in fact, naturally our guys on the ground has been quite adapt. I wouldn't say used to it, but then they've been able to adapt to the situation. As government started to implement new measures, wherever there are changes in circumstances, You just have to react on the ground. So I think from that perspective, operationally, we don't expect any significant changes from a risk perspective. And we'll take it as part and parcel of our life going forward until the world comes to a point where we can eliminate the COVID-19 altogether. So I think that's more the retail side. I think office side is a little bit more difficult to answer. I don't see so far a major spike in terms of risk. Of course, you hear a lot of news about bank downsizing. Some companies are decided to downsize, create a little bit of flexi work arrangement for their employee. I think those are not entirely new. In fact, many companies prior to the pandemic has already opted for some kind of flexible work arrangement to a different degree. Obviously, with the economic crisis that we saw in the last 12 months, I think that may accelerated some of the company that do decide to go onto the cost containment mode, and that's why you see some of the downsizing of space. But holistically, I would say once this crisis is over, I would think Singapore looks pretty good from a global map perspective. As a commercial center, retail, I think, will rebound, as you've probably seen from our first quarter result. Although the traffic number is only back to about 75% level, the sales actually has been performing quite well. Actually grew almost 3% on a year-on-year. So I think from the angle, we think that the rebound from retail could be strong, so long as we get that operational stability on the ground. What ultimately the consumer and in this case the shopper that we in Singapore want to see is some kind of comfort that things are under control in Singapore. On the office side, we have been dealing a lot with our own tenants. I think a lot of them are trying to work out essentially how their own real estate strategy will look like. Honestly, a lot of them have not really come to a conclusion. I think there's a lot of debate out there eventually about what kind of work arrangement is the most suitable. Different industry sector will have different views, different company, different culture have different views. But we certainly get quite a bit of a request, in fact, from our tenant to buy a little bit of time, especially lease that expiring in the next 12 months or so, just to extend another 1 or 2 years for them to observe the situation and come to a conclusion. So I think from that angle, office space sort of from a demand perspective may have a little bit of uncertainty. But in the long run, I believe Singapore will stand out good. A lot of multinational companies are actually expanding or intend to expand their presence in Singapore. Tech companies are setting base here, whether it's the Western tech or the Chinese tech company, certainly looking at Singapore as a good ground for them to look at their business strategy across the Asia Pac or Southeast Asia at least. So I think post-merger, obviously the immediate benefit is the diversification effect. Prior to that, of course, the investor has been putting a lot of concentrated bet on Singapore. Putting two together, it's still a concentrated bet in Singapore, but within Singapore, it's a little bit diverse with both the retail and office sector split almost 50-50. And among the retail space, it's also quite split 50-50 between the suburban and downtown mall. So I think we would, in the long run, have the stability effect will come in. And I think stability effect naturally in the long run with our wide base, I think will attract good liquidity going forward. Yeah.
Thanks, Tony. I think we've covered broadly several sectors and jurisdictions already over the last few minutes. But let me just bring back to Anthea, come back to Anthea. Given that the business dynamics of data centers are quite different from traditional property, what do you see are the growth drivers that are propelling Keppel DC REIT? Additionally, there are some other questions. I'm going to tag a question also from the tenants. Is that how does the tech sell down with regulatory limits on data centers in Singapore together affect Capital DC REIT?
Okay, sure. Thanks for the question. So I think maybe I'll address your first question first. So although the pandemic has brought on a lot of disruptions, it has also hastened the adoption of technology in businesses, as well as the way we live, including how the way we transact, the way we study, pursue hobbies, or even exercise. So this transition to a digital economy actually has brought on higher demand for data center assets globally. In the last 1 year, we have carried out quite a number of asset enhancement works to increase the leasable area for data center space. We also done quite a number of works to increase the available IT power. And all this is done to achieve, so as to achieve a higher revenue for our assets. And so far, we have been able to get our assets revenue generating the moment the fit out works are completed without any downtime. And capturing the higher demand from our end customers. So I guess going forward, apart from continuing with our proactive asset management efforts, we will also continue to seek acquisition opportunities globally, not just within Singapore, not just within the cities or countries that we already have a presence in. We will continue to look globally for good quality data center assets, anchored by strong, good customers in strong data center locations. Then I think going on and then also answering the other question about, I believe the question is asked regarding the limit by the Singapore government on conversion of existing industrial buildings to data centers or approving any additional land for construction of data centers. So there is a moratorium in place, and that actually limits the number of new data centers being completed. I guess that it's something that it's good for existing data center owners. But however, we believe that this moratorium will not indefinitely be in place. When it gets lifted, there may be changes to be made in terms of how perhaps the data centers are going to be designed, going to be operated, and going to be located. So I think that should be likely the way going forward for the data center developments in Singapore.
You just mentioned that earlier. You said that your strategy is not just about Singapore, it's about a presence and serving your clients globally, because I think I understand that you serve lots of multinational clients and they're present basically globally as well.
Yeah, that's right. So I guess there has been a certain. I think data center is a very unique asset class where the demand for data center assets is strong. However, the supply is sometimes limited because of certain either interventions by governments globally, or sometimes it can also be limited by the availability of well-suited locations, sites with the necessary power to the site. So I think that will always put existing data center owners in a very strong position.
You can imagine what Trump will say about this. Thanks, Anthea. Thanks for providing some more insight. I'm just going to bring in Simon. Commonwealth European REIT operates in many different European countries. You talked a little bit about this, Germany, Italy, a few minutes ago. Assuming that quite a few Singapore investors, like myself, are quite clueless about the European property market. How does Cromwell navigate the different local markets, property markets, at the different stages of post-COVID reopening to find good investments?
So Richard, again, I wish I could play the video of some of the beautiful cities that we're invested in. But when things open up, we'd love to host you and other investors through our European assets and finish up perhaps in Milan or Paris. But look, on a serious note, we have 220 people in Europe. We're in 17 different cities. We are actively engaging with our tenant customers, both. I think Tony mentioned this, at a time of crisis, a time of economic hardship, we've made sure that we've been in constant contact with our key tenants. We're also fortunate in some respects that throughout Europe, governments have not asked landlords or property owners necessarily to break contracts or to provide forms of rent relief. So one thing that we have been fortunate to avoid is really having to prop up our tenants from a financial perspective. That's not to say that some tenants have struggled, and I expect that struggle will continue just due to the poor economic conditions. But we've got a resilient portfolio. It's across 9 countries, potentially in 10, as we've identified recently. The UK as a target market from a logistics perspective, particularly up in the Midlands, where we're seeing a substantial amount of new tenant demand. So having a diversified portfolio does take away the risk of each country, and it does take away the risk of each tenant. I noticed there's some questions for the panelists here, and a couple are targeted as sort of, why do REITs grow? You're supposed to be bond-like. Why is there a focus on growth? Well, in part, it's to reduce the volatility of that distribution. So if our purpose is to deliver stable and growing distributions, and we're only a single asset owning trust, then if that one tenant was to come under difficulties, then by definition, the distribution suffers. So by having 107 assets, by having 800 tenants across 1.7 million square meters, this is a substantial portfolio. It's around 40% of the size of the Singapore CBD. This is a big portfolio, such that an individual tenant doesn't necessarily have the same impact in a larger portfolio sense. So I know sometimes there's a criticism of REITs acquiring assets. It's again, from our perspective, we do it in part to grow the distributions because we're able to buy properties at a 6% yield. And as most of your listeners will know, European interest rates are negative. So there's an incentive for us to get the cash out of the bank, which is unusual, but it's been a phenomenon in Europe now for a couple of years. And that's really to inflate real estate values and reflate real asset markets, such as well as the stock market. So we want to buy some of these assets. We've got people on the ground that are finding little nuggets, finding little gems. We've our recent examples, we've acquired a 160,000 square meter intermodal logistics hub in Italy. It's got 4 kilometers of rail siding. It's connected to European freight as well as key motorway. We acquired that asset on a 7.5% yield. We acquired it in part because our local guys on the ground were called up when a US investor failed to complete on the purchase because of COVID. They couldn't fly in to Italy, of course, and so the private vendor needed to sell. He rings up Cromwell, who has a 20-year track record in Italy and other parts of Europe in logistics and office. So having local people on the ground, I think, really is helping our unit holders today navigate through. Let's not mix our words. It's a double dip recession. It is a tough environment across the world. It's not just a health issue, it's also an economic issue. So having people on the ground talking with tenants, looking for nuggets to acquire is certainly something that our unit holders are investing in.
Since you kicked off it, you touched on this topic, and I will start the question with you, Simon. What is the interest? We talked about interest rate and inflation. What is the interest rate inflation, especially for the European Union, and how would this impact in terms of Commonwealth REIT?
Yeah, sure. So the inflation number for Europe just printed a couple of days ago, plus 1.7%. So we're getting this double benefit of very low interest rates to create inflation, and it's working. Inflation's actually coming through at a time of a recession. So every lease that we have in Europe in our portfolio has an inflation kicker on an annual basis. So we're able to tap into that higher rate of inflation. The second part of your question is, again, there's a perception often across Singapore investors that we talk with is, oh, Europe is low growth. Well, that may be the case from a population perspective, but some of these metropolis cities are actually growing. We see this in Tokyo in Japan, we're seeing this in Paris. in France. So overall, the French population might be declining, but your listeners would probably not necessarily understand that in the last 10 years, we've seen 2 million square meters of new office space being built each year. So every 3 years, the size of Singapore commercial market is being built in Paris. So that's a high growth market. The other reason we moved into Poland and other parts of Central Europe is because they are benefiting, similar to parts of the Asian economy, coming out of low wages, benefiting from back office, the BPO. So we see that in many of our office buildings in Warsaw and Krakow and Gdansk. We're seeing really good GDP growth, really good space take up. You were talking about very well-educated population, dual language, often German bilingual or English bilingual, a lot of BPO work, a lot of manufacturing being outsourced. So a lot of Western European companies setting up manufacturing hubs in Czech Republic, in Slovakia, benefiting from being very close to Germany, in fact, neighboring Germany. It's a bit like, you know, Malaysia to Singapore. We're providing in this Central European context, you know, a lot of that manufacturing for Western European countries.
Thanks, Simon. So if we could just bring in Jeff. Jeff, do you have any further input as well in terms for the outlook in terms of interest rates and I think interest rates as well as inflation?
So one of the reasons why I guess the REIT sector in Singapore wasn't such a strong performer in the first quarter of this year was basically your US yield curve doubled. It went from, you know, the price, the yield spread between the 2s and the 10 notes basically doubled from 80 basis points to 160 basis points by the end of March. And because of that, you had that as an extra lift to the banking sector, and global banks were, you know, basically the strongest sector across the world for the first quarter of this year. And that's the reason why the STI was the second best performer across the APAC region and one of the top performers across the world, because we're 40% weighted to the banks. But for the REITs, and we now have 7 REITs in the STI, they make up 15% of the STI versus the banks that make up 40%. The REITs, we've seen more outperformance in the small to medium sized REITs than we have in the larger REITs, not just in Singapore but across the region. That has been noted. So basically, it was, you know, the interest rates had really been setting a lot of these sub trends in the financial sectors that comprise the banks and the developers and obviously the REITs. For the inflation perspective, it is creeping up higher in the US. I think the print that is expected tomorrow night in the US is double what Simon was saying in the Europe. I think we're expecting 3.6% year on year for the next inflation report in the US, and that's growing month on month. The commodity prices have really continued to gain. I mean, you look at so far for the second quarter, stocks and equity markets, bond markets have been relatively steady, but commodity momentum has notched up. Commodity momentum in the first half of the second quarter has been twice the upward momentum that commodities posted in the first quarter. So that is in the background. And then you've got US CPI growing. I think it was month on month, it grew 0.3% in January, up 0.4% in February, up 0.6% in March, which on a month on month basis was the highest print for the gauge since June 2009. And tomorrow night at 8:30, we'll have that key number. And I think the consensus estimate is for it to come in and only be 0.2% growth month on month, but nonetheless up 3.6% year on year. And that has been a goal. The Fed has been comfortable with the inflation target. I think what the surprise was the unemployment number, but nonetheless, both the ECB balance sheet is above 7 trillion euros. The Fed Reserve balance sheet is getting closer and closer to 8 trillion US dollars. They have expanded significantly, and the Fed chair, for instance, has been committed to seeing this out with keeping rates as they are. Now, in terms of those rates being too high, those 10-year yields being potentially too high, not the last FOMC, but the FOMC before, the CNBC reporter, Steve Leisman, did really push the Fed chair on an answer on whether he would actually look at tackling and targeting to keep the 10-year rate lower. And the Fed was resolute in high interest rate at that time, around the 1.5%, as completely orderly. And then that response had seen all the press basically drop the questioning on the 10-year yields completely in the next Fed, in the most recent FOMC. So it seems that the yield curve has really it took a lot of focus in the beginning of the year, but the yield curve has got less focus now. And then obviously inflation's the bigger focus at the moment.
Thanks, Jeff. I think we'll just have to wait for tomorrow for a little bit more updates. Correct. Let me bring Tony back in. Today we have CICT is really the largest REIT listed on SGX. This was really formed by the merger of CMT and CCT in November 2020, which combines retail, office, and integrated development into one REIT. How does CICT leverage its diverse portfolio to drive value for its shareholders? You know, I think they're looking in terms of how they see this outlook as well. Tony.
Yeah, sorry. So earlier I did touch on about the diversification. In fact, I mean, that's precisely one of the effect of having that merger. With a diverse base of 22 assets, comprising 3 sectors, actually we have in a way sectoral diversification. Retail, office, and integrated on its own is a product that sort of ring fences its own cycle. So I think from a diversification effect, in the long run, it should bring stability to the REIT and the REIT performance. But in the more operational layer, I think we do see a lot of synergy from a cost perspective. Naturally, with two entities operating in the commercial space, I think there's a lot of area that we have been able to tap on from a scale perspective. Whether you look at bulk procurement, you look at the operation on the ground, it's certainly there. Over time, there will be area that we could look at to save costs. But beyond that, I think the other part is also the effect of having the merger is, in the long run, should also translate into potentially a lot of possibility of cross-marketing different space to different kind of user. Today, I think we have not looked into the case where company may start to think about their real estate needs. I did touch a little bit on that, whether it's going to be a core flex arrangement and a flex arrangement. Where would they want to be? Are they going to put it near to where the people are living? That's one strategy. Naturally, also it could be a case where they look at the hub and spoke, and where they want the hubbing to be and the spoke to be. I think we would have that possibility to explore the different kind of configuration over time. So when I talk about the benefit, naturally you come from the cost perspective, and I think in the long run we probably will see a little bit on the revenue side as well. Yeah, and collectively as a whole, post this pandemic, obviously, I think the market will go into its natural property cycle. And having that diversified base will naturally allow us to ride the cycle and take advantage accordingly. Yeah.
There's a question here by one of the, I think someone from floor, talking about, asking specifically about CICTs, take about the management fees in terms of shares, and they're asking, is, you know, by doing this, is this shareholder friendly?
I think it's not uncommon to have a payment, especially to the manager in units, right? To a large extent, you're also trying to align the interests of the manager to the REIT unit holder. Of course, we take reference to what the market has been doing. Today, I think we have been doing a 50% in units form and 50% in cash, quite balanced. I think there are other peers who have different configuration. But having said that, I don't think it's cast in stone forever. It's something that we'll review over time as well.
That's great. Okay, thank you, Tony. So I'm just going to the recent. I'm just opening this to the panelists for your input. The recent announcement of the deconsolidation by SPH of its media arm, leaving it only its property business, caught, and I mean a lot of shareholders and even Singaporeans by surprise. How would this change the competitive dynamics of our already crowded field? Tony, maybe I'll start with you, since it's really they're also very much in Singapore.
I don't think per se would change the competition dynamics. I don't think so. Of course, naturally, it depends on the outcome. But as far as I'm concerned, SPH is a conglomerate. It's a mix. Of course, they have diversified business other than the media side. A huge part is in the real estate side, largely probably in the, if I read, from based on the news release, major holding in the REITs, SPH REITs. REITs own a couple of assets, in Singapore and in Australia. In Singapore context, they own Clementi, Paragon, and then Real Mall. I would say they complement the entire retail ecosystem. Whatever outcome, I think SPH REITs will still be running the as far as I see, the property is still going to be there, whoever owns it. So I don't think I don't see any significant impact from a competition landscape. Yeah.
Jeff, I just bring you in because I think with all this discussion with the SPH hiving off its media business, in terms of and I think a lot more from that perspective. What's your thoughts and views and comments and inputs?
Yeah, just checking. You're asking me, right?
Yes.
Okay.
Yes.
Okay. Yes. Yes.
Broader,
no, it's okay. Yeah. Sorry. Look. Okay. So the stock price got up to as high as, I think, $2 earlier in the year. So it's had a really big move from the end of October. It's moved from 99 cents to $1.58, I think, as of the close today. Yes. Now that's a really big move. Going into this, at the end of October last year, it had the highest, the biggest aggregated short position. I think that it's aggregated short position on SPH as a percentage of outstanding shares was something like above 8%, and then subsequently had fallen to below 4%, so at less than half. And for much of the year, the stock was also a top 20 traded stock by turnover, and it had seen net proprietary inflows, net institutional and proprietary inflows of $85 million. So there was some, obviously, I'm not sure if it took the market entirely by surprise, because I think there was an expectation there would be some restructure of the media business. I think maybe the surprise was in the not-for-profit entity, because that was the main talk. And of course, in the presentation, the SPH management did note on a pro forma basis, it will potentially reduce the net asset value of the stock by 7%. And hence the stock is down, I don't know, around down 10% from where it was prior to the actual announcement, down 10 or 15% thereabouts. But Rich, the strategic restructuring of corporate assets and the direction, redirections and diversification or divestment in some cases, acquisitions, changing businesses, that has been a real key theme for our Singapore stock market over the past 12 months. And I think it's a really good thing, because it does parallel that we do obviously say that Singapore does have very high global rankings in business efficiency surveys, places to do business, etc. We are expected to, when the winds change, we change our sails. We move with the direction, and we restructure and change where we can. And as Tony said, the non-media segment of SPH has been growing. For their FY20, their non-media business made up 49% of overall revenue, and that's up from 24% share back in 2014. And that's not just the declining media business. That non-media revenue in absolute terms has grown close to 50% over the 6 years. And there is that SPH REIT as well, which it owns, I think, 66% of approximately. And of course, that reported 45% year-on-year growth in its DPU for that half of the year ended in 28th of February. And the purpose-built student accommodation portfolio as well recorded, I think, 24% growth in revenue as well for its half of the year ending of the 28th February. Interesting too that SPH REIT has that Westfield Shopping Centre in Marion, Adelaide, has an interest in that, and that's where there is this is quite funny. There's bread talk is so popular here in Singapore. There's actually a company in Australia called Bread Top. It's got the same logos, it does the same breads, but they're completely not related. So SPH might want to get in there and maybe do something with Bread Talk. But more on a serious note, Rich, look, in terms of the need for SPH to be able to focus on a transformation strategy into the digital world, that's really important. That's really important. You look at the likes of the top media stocks these days. It's the likes of Facebook, Netflix, Spotify. 20 years ago, it was Time Warner, News Corp, Sky PLC, and so forth. And just one more thing. I don't know. I don't necessarily agree that it's an overcrowded space. I mean, the provision of high quality news and information to the public has been, I think, used to great effect here in Singapore with both MediaCorp and SPH, relaying really important information on the do's and don'ts to help contain COVID-19 here in Singapore. So, if anything, I think the past 12 months have showed us that we do need to have and protect and make sure we can sustain our key media companies here in this country.
Richard, if I may, from a real estate perspective, sort of bringing it back to today's topic, one of the sources or pipeline of real estate that we've come across is actually working with restructuring companies where they may be looking to offload their real estate in a sale and leaseback type structure. So some of the German assets that we bought last year were exactly part of a corporate restructure where the OpCo didn't need the PropCo, and we were able to come in and take the real estate at a very good yield on 15-year lease. So while not commenting specifically on SPH, I do want your members to understand that corporate restructure does provide often a real estate angle for us to pick up on.
Thanks, Simon, for jumping in. Can you just stay for a second? There are a couple of questions here specifically for you. The first one is that, what was the purpose of the 5-to-1 share consolidation that you currently recently exercised? And also, staying with yourself, what are the foreseeable risks for Commonwealth E-REIT? And how would you be mitigating those risks?
Yep, some good questions. So we were thrilled a few weeks ago at our EGM to get a 99.7% ratification of the resolution to consolidate, or reverse split, as it's sometimes known in some markets. So why did we do it? Well, when a stock like us, a mid-cap stock, roughly 2 billion Singapore dollar market cap with net assets of roughly, again, 2 billion Singapore dollars, when we're trading at 43 cents or 39 or 42 cents, somewhere in that bracket, because the Singapore Stock Exchange only has a half-cent tick. In other words, a bid might be at 43 cents and the offer might be at 43.5 cents. So if a seller of S-REIT units or of any stock wants to match their price with the buyer, just like selling an apartment, if you want $100 for your apartment and someone's only prepared to pay you 90, someone has to cross that spread, if you like, that gap. And that's very wide under the Singapore tick convention. So doing a 5-for-1 brings us up now to $2.40. And so the 1 cent move, the 1 cent bid-ask spread as a proportion of the total trading costs comes down materially. So we go from being a 1.2% cost of buying S-REIT or any stock with a low price to now being more like 0.4%. So as a REIT, where most of our returns to investors is through our high yield, a 7% yield, reducing that initial cost to actually participate in our share price is really important. So having been an analyst and an advisor in real estate for 25 years, we were able to go back to many case studies, many examples, both in Singapore, where we've seen one REIT do a reverse split, and through Australia, where many REITs have done a reverse split. And we've seen that it's improved the liquidity of the stock. It's reduced the volatility. It's reduced that intraday movement of 1 to 1.5% as investors are moving in between the bid and the offer. And so we've seen actually share prices improve, trading much closer to fair value, because that friction, that trading cost is reduced. Simply, it's one pizza. We haven't changed the size of the overall pizza. It's still the same pizza. It's just our slices now are 5 times the size. In terms of the second question, it was more around the risks to the income. Is that right?
Yes. And what are you doing? What do you see? What are the foreseeable risks? Because I think a lot of Singaporeans, they don't have a chance to fly out to Europe, and you're also very diversified. You mentioned earlier. And what are some of the foreseeable risks? I think a lot of the Singaporeans are not really used to the European property market, understanding its nuances. And how do you mitigate it? And I think you mentioned one of the earlier mitigation risk of having people on the ground.
It's very local business, real estate. Everyone knows it's about being in the right location and having the right people, the right connections. And so I'm certainly not sitting here in Singapore, making decisions on the ground in Helsinki, or having that communication with the local gymnasium or the local coffee shop. But we have people, that live and breathe this. So the key risk is we're in a recession. And so the stock market prices ahead of what's going on today. And so when Jeff showed that office REITs have been strong performers this year, it's not because the conditions on the ground today are fantastic. They're not great. It's the expectation that the economy will improve, and that service companies that typically occupy office space start to return. They start to settle down. They start to look at their longer term growth projections. And we've seen, for example, in the Netherlands, sometimes people think the Netherlands is tulips and great cheese, but it's actually a very high tech country. And so pre-COVID, 18% of white collar employees had flexible working arrangements, were already working from home prior to COVID. Yet the vacancy in Amsterdam, across the whole office market of Amsterdam, was 2%. So we shouldn't get alarmed that over a medium term, just because many countries, the population will feel, it's been a good experiment to work from home. Let's have a hybrid. Let's do 3-4 days in the office, 1 or 2 days at home. That's not the end of office. There will be a period, a transition period, sure. But the light at the end of the tunnel is that we're returning to economic growth. We're going to return to greater profitability of our tenant base. And so really the risk is, how long will that take? And we'll be able to take all of our tenants with us, or will some drop out through the recessionary impact? So, we're very encouraged by the last couple of weeks. We've only provided around 200,000 euros only of rent abatements. So really it hasn't been a big concern to date around having to hand back rent to tenants.
For the insights into what's happening. I love Europe. I haven't been there for a while, but I'm looking.
Go to our website. We've got wonderful photos.
You just made me reminisce of what I miss.
Hey, Rich, can I just cut in there?
Yes,
with Cromwell, I had the old counter names when I had that slide up, and I'll just make a point that I will send you those 2 slides so you can distribute it, of course, to any of the viewers tonight. But Cromwell REIT, it has 2 counters on the exchange. It actually has a European denominated counter, which is CWBU, which closed at $2.40, how do you say, 2.40 euros. And then the Singapore dollar counter, which is CWCU, which closed at $3.83 Singapore dollars and 83 cents today.
Yeah, I think that's an important point in that, we talk a lot about Europe, and around 80% of our investors want to receive euro dollars in their dividend because they've got US dollars, they might have some RMB, and they obviously have Singapore dollars. So 80% of our investors choose to receive euro dollars, but still 20% of our investors choose Singapore dollars. Local investors, they don't have a euro account. It's much simpler to receive Sing dollars. So, we're very thankful that the SGX has the technology to be able to have completely the same company trading at exactly the same time in 2 different currencies. So again, we don't want to confuse people. You can take Sing dollars and you don't have to worry about it, or you can take euros and trade the currency if you wish. Thanks, Jeff.
I'm just going to pose this question to Anthea. This is about a question about Keppel DC REIT. And this question is that, first, an observation. Then there are other peers in the REIT sector venturing into the DC space in recent years. What are your competitive strengths really, what are your competitive strengths, and how do you stand out? How well do you stand out?
Right. Thanks for the question. So for us, actually, we own data centers, and we own, apart from the master lease ones, we also own the co-location data centers, which means that we have to manage and operate these data centers. So I guess that differentiates us from some of the other REITs that just buy the data center and maybe only hold it as a master lease basis. Then I think in terms of we also have a Keppel Group that apart from just managing these data centers, they also design and develop data centers. So we have a Keppel, the data center fund, the private equity fund that develops data centers. So whereas as a REIT, we do have our limits in terms of the amount of development activities that we can go into, whereas the private equity fund focuses on developing data center and exiting or selling divesting when they are stabilized. And that actually, we will actually be a natural buyer looking at such opportunities. I think Keppel Group has also embarked on quite a number of innovative designs in the way data centers are being designed and operated. For example, Keppel also look into how data centers can operate in tropical data centers, can operate with maybe less cooling required for data centers. And Keppel has also looked into near-shore floating data centers or other alternative forms of fuel to power up and cool data centers, like for example hydrogen or LNG. liquefied natural gas to cool and power some of these data centers. So I think for us, perhaps as a REIT, focusing on data centers, we are actually in a stronger position, having the advantage of the capital group to provide us the pipeline as well as to operate these data centers on a global basis. Thank you.
Since we're on Anthea, I'm just going to ask these questions about sustainability and the environment. These are this is something that is really beginning to be the forefront of investors today. As a REIT, how does sustainability and ensuring that in the environment, I think if you just mentioned about some of the diversified power sources, because it's about sustainability. How does a REIT look into that and report about that? And how do you engage your investors about your sustainability efforts?
Right. Thanks for the question. So for us, I think, apart from, seeking opportunities to bring about a more higher efficiency on our data centers in terms of power efficiency, as and when we carry asset enhancement works, we always look at whether there are more efficient equipment to replace with the existing ones, so that we can always try to maintain the efficiency of our data centers. We also look at certifications, like for example, all our Singapore data centers have been certified by Green Mark, which has a specific category for data centers, and we have achieved a platinum or gold plus. I think apart from certifications, we also look at sourcing for renewable sources of energy. Like for example, the 2 data centers that we have in Dublin are both powered by renewable sources, which is wind energy. So I think wherever we can, we will try to find the more sustainable ways to look at how we can, notwithstanding the fact that data centers still consume a lot of electricity. I think there's no running away from that. But I think there are also ways how we can better utilize whatever resources that we have.
Richard, we also have a data center up in Copenhagen, and echo Anthea's comments. It's not just electricity, of course, it's also water. So again, we have to be very careful with the cooling process, and so obviously the Nordics, where it's much colder, we have less need for the cooling. But to her point again, being a landlord-only model, which is our model, does limit the opportunities, because clearly we don't want to take on the operating risk. We're very happy for one of the hyperscalers, one of the large cloud providers, to take on that risk. So that's something that would differentiate our model to Anthea's model. The unfortunate part of that, of course, is if we look at last year in Europe, there were only 6 data centers that traded versus almost 1,100 logistic asset portfolios. So, our ability to pivot towards logistics is we have a much greater liquidity, much greater opportunity to pivot towards logistics than the data centers. I know we've come out to say we'd like to increase our exposure to data centers, but again, our investors have to be very patient, because we don't have the operating model. So we do need to partner with the cloud operators that are prepared to sign leases. But we just, again, cautious around our risk return profile.
Can I bring you in, because I think with talking a bit more about sustainability and sustainability efforts, how is CICT also looking to advance sustainability, and especially being in Singapore, how do you advance the sustainability discussion here in Singapore as well?
Yeah, thanks for the question. I think sustainability has always been a very important factor. In fact, of course, sustainability is a larger word now. In the past, CapitaLand has always been very focused on looking at environments. Of course, along the way, have been incorporating the governance aspect. But at the end of the day, I think CICT ultimately what we're trying to do is to aim to generate stable and sustainable returns to our unit holders. It has to be underpinned by our commitment to the 3 ESG issues. We are able, we have been fortunate that we've been able to leverage on CapitaLand sustainability focus, has been shared by in their Master Plan 2020, which essentially focus on 3 key pillars to drive our efforts, namely to build a portfolio resilience and resource efficiency, enabling thriving and future adaptive kind of communities, and also accelerating sustainability, innovation, and collaboration. So I've been working alongside with different partners to look at ways to, to evolve as an owner of the real estate. And as a group with CapitaLand target, we are setting ourselves towards transiting into a low carbon business that's aligned with climate science, such as targeting emission reduction to below 2%, 2 degrees Celsius scenario. So I think that's very important. Of course, at each stage of our real estate cycle, sustainability is integrated. For instance, if we were to invest in any real estate, we definitely will conduct an environment, health and safety impact analysis so that we are aware of the impact on the real estate and what kind of action that we may need to take should we decide to pursue it. For existing operation, obviously, I think we strive for operational excellence, and then we set out targets for energy and consumption savings by 2020. So there are quite clear guide and targets set forth, and all these are actually reported to our unit holders in our annual report.
I think these are some of the conversations that are growing, and today for a lot of investors don't realize that ESG investing, impact investing. I think these are some of the things that there will be further discussion about this over the next few years. This becomes one of the key things, and environment becomes a very key aspect for basically all our lives, and that is going to be moving forward. Maybe I just want to do is just because we're almost running out of time. I just wanted to start with Jeff, and just highlight in terms of what are some of the key risks from your point of view investing in REITs today. I mean, obviously it is a growing asset class, but what are some of the key risks that you would like to investors take note of as we close this session today? I mean, what are some of the key risks that we should take note of?
I mean, always the biggest risk, Richard, is market risk, and those market risks that I think the REITs provide are really based on the portfolios, and that can be assessed by looking at what's in the portfolios. And there's been a lot of discussion about diversifying where in the world a lot of these properties are located, and having different properties and so forth within the actual portfolio, and the benefits of diversification. The good old adage that we talk about in many CS events. But look, you can also concentration can also serve its point as can also serve its role as well, because like Keppel DC REIT is here, and there was a question just before, how does it how does it perform to its peers? Well, if you look at the world's biggest data center by market value, Equinix, since Keppel DC REIT was listed back in December 2014, Keppel DC REIT has kept in pace with the world's biggest data center REIT. I think annual total return on an annualized basis is around 23.5% for Keppel DC REIT, and it's around 22.5% for Equinix. So they've moved, the trend in data centers has moved somewhat across the world, and Keppel DC REIT has provided a great platform for those investors to have exposure to it. And then, of course, as I said, it all comes down to market risk, and they all have very different drivers. So I would encourage investors to engage with the resources, particularly that the hardworking investor relations teams put together, because there's great information there. It's very well presented, and for investors, keep doing your homework. And if you're a little bit worried about market risk, From a timing perspective, of course, there's a growing trend here with Singapore investors in terms of TWAPing or dollar cost averaging, where you can focus on a few securities, but don't go lump sum with the money at the one point in time. Spread it out over a couple of months, a couple of quarters, or even a couple of years if need be. Nonetheless, as I said, market risk is the big one, and you've got a wealth of information provided by the REITs in their investor relations presentations you can get from our SGX corporate announcement pages.
Althea, just want to give you as a lady to start off, kick off in terms of just closing remarks in terms of what are some of the key risks that investors should take note of when investing in Capital DC REIT.
Yeah, thanks. I think in terms of key risks, I think as with any form of investments, there will always be risks. Any form of market risk or risk related, maybe not specific to the assets that we manage, but to the wider global economy. But I think the key fundamentals that are important for investors to take note would be that investing in data centers is investing in the asset class that is resilient and has proven to be resilient even through the pandemic, has proven to have sustainable strong demand with the move and adoption of technology. And I think also our good track record of carefully selecting the assets that we acquire, ensuring that everything we buy is good and sustainable for us in the longer term actually will be the key things that investors could look out for. Thank you so much.
And Simon, just one key takeaway, for someone who is just dying to run out there to buy Commonwealth EREIT, just what's that one key takeaway, a risk that we should take note of before?
Well, Richard, I've obviously talked a lot about the risks. So just very simply, our REIT with 800 tenants, 3 billion Singapore dollars in size, a 7% yield, exposure to the world's second largest economy. So thank you for your time.
Thank you. And Tony, just as to close off in terms of just summarizing, is one of the key things that people should take note of before investing.
Obviously, it's like I mentioned from earlier, I think it's quite a concentrated bet in the faith in Singapore commercial real estate, right? And if investors generally are confident in the Singapore context, then of course this is a good platform to be invested in. From a capital market and capital management perspective, I think we've been quite resilient. We look at our capital structure, the debt maturity is all well paced out, very high fixed rate and interest rate hedge ratio, in the likes of 85, 86%. So I think on the whole, I would say it's pretty a well diversified, low risk, I would say, investment in Singapore. Of course, I think there will be property cycles that we ride through. Naturally, with the diversification, we definitely hope to reduce that kind of volatility in terms of financial returns.
Thank you, ladies and gentlemen. Thank you, our panelists. Thank you for taking your valuable time and providing insights. We've covered a wide range of topics and asset classes. At the end of the day, don't put all your eggs in one basket. Diversification is something that you should look at, and really, before you invest, understand the company, understand the sponsor, understand the businesses before investing. With that, ladies and gentlemen, thank you. Have a good evening, and to our panel, Jeff, Anthea, Simon, and Tony, thank you for joining us again, and have a good evening.
Thank you very much, everyone.
Thank you.
Thank you,
Thank
everyone.
you.
Bye.
Thank you.
Thank you.